I know you've been very cautious, let's say, about the performance of the economy. It sounds like consensus has certainly caught up to you. What's your latest thinking?
Well, yeah, I think we're in agreement with former Fed Chair Janet Yellen, and she was, I believe, invoking what's called Okins Law. Arthur Okun, the Yale professor, came up with that rule of thumb based on his historical relationship between unemployment and GDP, basically dictating a 1% rise in unemployment coincides historically with a 2% drop in GDP. And that's where you get those kinds of numbers. So it's very possible that the fly in the ointment there, of course, is that relationship historically is very strong in the normal or typical ranges of unemployment, not when you start hitting double digits. So
right.
We'll have to see if it holds. But we're still very cautious here. The market seems to be very anxious to believe in a V-shaped, quick recovery here, certainly a strong second half. And there's a lot of downside and vulnerability here, both medically speaking and economically speaking, to turn this into a U or worse. So we're a little more cautious.
I thought it was interesting that you say you see potential everywhere, but the tougher question is when. What makes you so sure that it's better to wait as opposed to, moving on that opportunity that you do see in front of you?
Oh, because what's happening, for example, today, there's some good news on curve flattening, both in China and now New York. But even with good news on the virus front, the economy could still be vulnerable with secondary effects, secondary and tertiary effects, supply chain disruptions, defaults and bankruptcies and credit downgrades to come. So financially, the fallout could be much worse, even if the virus were to trend off here. So we do see a lot of opportunity, and of course, the old adage, buying on the dips, it really works. But I've never heard anybody say buy on the recessions, and we're still just starting into a pretty bad recession.
Let me bring you in, Scott, on that note. If you want to respond to kind of the way that Rich is approaching this, I see here that you also would stay away from the small caps right now, which in the last week or so we've heard different voices saying maybe there is some value there. It doesn't sound like you're one of them.
No, Kelly, I tell you, we've been underweight small caps for a long time, typically late in the cycle. They're underperformers. You can see that today they're outperforming by about 100 basis points relative to the S&P. So they would typically, in a normal cycle, whatever that is, halfway through the recession into the early years of the recovery, small cap and value outperform. So I don't think we're there yet, but we're certainly trying to pay close attention. For us, we've been recommending that clients, to stick a toe in the water on big down days. They can be patient. We've had obviously a really good bounce off what I would call a panic low. We've been here at 2730 three times in the S&P 500 over the last, let's say, 5 or 6 trading days. So there's resistance there. There's resistance up at 2750. If history is any example, you're going to have a pretty good bounce, but then you're going to have a pretty good meaningful pullback. So, we continue to think that this is an opportunity. We expect a sharp but relatively short recession. We want our clients to stick with large cap, growth type, quality stocks right now.
Okay.
Tech, consumer discretionary. We like communication services. So for us, we're looking at this as an opportunity that we want to actually take action on and leg into on these big down days.
So yeah, you are starting, like you would say, to kind of tiptoe into these markets. And I thought Rich's point was interesting that, he says you don't want to buy going into a recession, but we know you do want to buy coming out of one. In 2009, I think the market bottomed in March, but the recession technically, Scott, didn't end until June. So if this is a short event, we could already be needing to think about coming out of it, or is that too early?
Well, you can tell the market's thinking about it today with the small cap outperformance, I think, and really sector-wise today. And, today's, of course, only one day. It's a little more mixed in terms of sectors, but certainly at some point here, it's going to be these more cyclical sectors. It's not going to be defensive sectors, staples and utilities that lead us out of, eventually out of this bear market and take us higher. It's going to be things that are sensitive to the economy. So that's what we want to be paying attention to. And like I said, we expect a sharp, very sharp, but relatively short recession here, where you see positive GDP in the fourth quarter, and then you see some better news. Not wildly better, but better news for 2021.
Rich, quick final word on that. If we are talking about positive GDP by the fourth quarter, do clients need to be thinking about kind of gingerly starting to buy here?
If you have speculative money, powder dry for sure. If your risk tolerance or your tolerance for risk is very high, but if you're talking about your 401ks, retirement savings, again, treat them like your face. Don't touch them.
Okay. All right. Thank you both.